Hey everyone, and welcome to another deep dive. This time we're tackling business analysis, getting down to the nitty-gritty of how to understand and analyze a company's performance.
We'll be drawing from an article by financial analyst Dr. Vijay Malik.
How to do business analysis of a company. So, get ready to level up your business savvy.
It's a great piece, full of insights.
And you know what? He says it all boils down to two key factors.
Okay.
Like two factors to rule them all when you're trying to figure out if a company is going to be a winner or not a winner.
Exactly. Uniqueness of the product and the amount of competition.
He really hammers on those two things. I'm curious, why are those two so important?
Because they directly impact a company's pricing power. Can they raise prices without losing customers?
Pricing power.
Right. If a company has a unique product or limited competition, they've got leverage. Customers have fewer alternatives, so they can charge a premium. But if their product is easy to copy and the market's flooded with competitors,
They're stuck.
they're stuck in a constant price war, and their profits run.
So basically, a company with a moat, that durable competitive advantage we always hear about.
They've nailed those two factors.
Nailed it. Okay, so Dr. Malik uses some really interesting case studies to show this in action.
He does.
Let's start with Supreme Industries, Ltd., a major player in the plastics industry.
They've seen consistent sales growth between 7% and 9% every year for the past decade.
Now, I know what you're thinking, 7-9%, that's not exactly setting the world on fire.
But in a mature industry like plastics, that steady growth is actually a really good sign. Points to a very healthy business.
And get this, they can raise prices to match rising raw material costs in just 2 to 5 weeks.
It's impressive.
That's lightning fast. Most companies would be scrambling for months.
They're able to adjust prices so quickly and strategically focus on high-value products. That helps them avoid the really intense competition from imports or the, unorganized sector.
So they're choosing their battles.
Exactly.
Okay, so we've seen a company with stable performance. What about a company that's actually improved its position?
Yes, Dr. Malik talks about Associated Alcohols and Breweries, Ltd. They operate in a highly regulated market liquor, but they've managed to boost their profit margins.
From what to what?
From 7% to 15%.
It's more than double.
It is very impressive, especially in that market.
How'd they pull that off?
Smart moves. They invested in a multi-grain facility, which gives them flexibility. They can switch between different raw materials based on price fluctuations. So if the cost of one grain spikes, they can move to a cheaper option.
They're hedging their bets.
Exactly, protecting their margins.
Very clever.
And they didn't stop there. They shifted their focus to premium liquors, higher prices, less price-sensitive customers.
So they're not just selling more, they're selling smarter.
Precisely, finding those pockets in the market where they can command a premium.
It's like they've built their own little moat within a really competitive market.
Absolutely, a great way to put it.
Okay, now for the flip side. What happens when competition heats up and a company's moat starts to crumble?
That's where things get interesting. Think about Quick Heal Technologies, the antivirus software company.
I've heard of them.
They've seen their sales stagnate and their profit margins shrunk from over 50% to 32%.
Ouch, that's gotta hurt.
The culprit: intense competition. They're up against giants like Avast and Symantec, offering free or extremely low-cost solutions,
Yeah.
which basically undercuts Quick Heal's pricing power. Their product is good, but customers see it as a commodity. Lots of similar alternatives, so why pay a premium?
So they're trapped in a race to the bottom.
Exactly, constantly having to lower prices to stay competitive.
Okay. We've seen stable performance, improved performance, and declining performance. What other scenarios are out there?
Well, we have to talk about cyclical businesses, companies whose fortunes rise and fall with the economic cycle. Dr. Malik uses HEG Ltd., a graphite electrodes manufacturer, as an example.
Okay.
Their sales and profits. They've experienced some dramatic swings. Revenue peaked at a massive euro 6,591 crore, then plummeted back down.
Wow, that's a roller coaster.
It is. And it's typical of cyclical industries. Companies tend to ramp up production during good times, which leads to oversupply. And then what happens?
Yeah.
Prices drop, profits shrink.
So it's like a boom and bust cycle.
Exactly.
Yeah.
HEG's experience during the 2008 financial crisis illustrates this perfectly. They had big expansion plans in place, but the crisis hit, demand crashed. They were left with excess capacity and losses.
So even seasoned players can misjudge these cycles.
It happens. Knowing the pattern exists is one thing, but predicting its exact timing?
That's tough.
Nearly impossible.
Yeah, it's like trying to time the market. But on a way bigger scale, you'd need nerves of steel.
Exactly. Now, all this analysis might sound pretty time-consuming.
Yeah. It was time to sit there poring over every financial statement.
Right.
Most of us have, lives, jobs, things to do besides becoming financial analysts.
Well, Dr. Malik actually offers a shortcut. He calls it the short method.
Ooh, I like shortcuts.
It's a way to assess a company's strength even if you don't have hours to spend on research.
Okay, give me the SparkNotes version.
Focus on consistent year-over-year sales growth. That's your proxy for a moat.
So basically, if a company's sales are steadily growing over time.
It's a good sign. Indicates they have something special, something that sets them apart.
Got it. So steady sales growth, potential moat. But he doesn't stop there, right?
No, he breaks it down further. 5 key checks to help you really dig in.
5 checks. Okay, I can handle that.
First check. Compare the company's sales growth to its peers. Are they outperforming the competition?
So, check number 1. Are you beating the other guys?
Exactly. Check number 2. Sales volume growth. Is the company actually selling more products or services? Or are they just raising prices?
Because at some point, you hit a ceiling with how much you can charge.
Right. Check number 3. Profit growth. Sales are great, but they need to translate into profits.
You can sell a ton of stuff but still lose money if your costs are out of control.
Exactly. Profits are what matters.
The bottom line, literally.
Check number 4. Cash. Are those profits turning into actual cash? Or is it just accounting tricks?
Cash is king.
Absolutely. The lifeblood of any business.
And finally, check number 5.
Value creation. Is the company creating more than $1 in market value for every dollar it keeps in the business?
So it's about how efficiently they're using their retained earnings to grow and reward shareholders.
Exactly. A measure of their long-term potential. Dr. Malik gives some great examples. Astral Polytechnic Ltd., they pass all 5 checks with flying colors.
So they're like the gold standard here.
You could say that.
Growing sales, increasing volume, making profits, turning those profits into cash, creating shareholder value.
Whole package.
As companies like Tata Steel and ONGC.
They stumble on some of these checks.
So even big, well-known companies aren't immune.
This method can help you spot those weaknesses.
That's really interesting. Okay, so we've got the short method. What else did Dr. Malik cover?
Well, he had a section where he answered questions from readers.
Oh, I like those. Get into the nitty-gritty.
Yeah. Real-world dilemmas investors face. For instance, one reader asked about a company where retained earnings were increasing, but its market cap was decreasing.
Huh. So they're holding on to more profits, but their overall value is going down.
Right. And the reader was worried about what that meant for dividend investors.
Yeah, if you're relying on those dividends, but the stock price is tanking, it's not a good situation.
Dr. Malik stressed that both dividends and share price appreciation are important for overall returns.
So even if a company pays dividends consistently, if the share price keeps falling, it might not be a good long-term investment.
Exactly. Retained earnings should ideally lead to value creation. If they're just hoarding profits, that's a red flag.
Could mean they're not managing things well.
Huh.
Or the business itself is facing some challenges.
Another reader brought up Warren Buffett's dollar-for-dollar rule.
The idea that a company should create at least $1 in market value for every dollar it retains.
Right. But the reader pointed out that this might not always be true, especially in volatile markets.
Like during a bear market.
Exactly. Even good companies can see their market cap drop, regardless of how well they're using their retained earnings.
So the market doesn't always reflect a company's true worth in the short term.
Dr. Malik agrees. But he says the dollar-for-dollar rule is most meaningful over the long term, at least 10 years.
So don't get caught up in short-term fluctuations. Look at the bigger picture.
Exactly. Focus on the fundamentals.
These Q&A sections are gold. They address those practical questions we all have.
Real-world context.
Speaking of real-world challenges, another reader asked about finding data on production capacity and sales volume.
It's not always easy. That information isn't always in the annual reports.
You got to dig sometime.
Dr. Malik suggests looking beyond annual reports. Credit rating press releases, equity research reports, company websites.
Expand your research.
And if all else fails,
What then?
contact the company directly and ask.
I like that. Go straight to the source.
Shows initiative.
While we're on the topic of digging deeper, how do you figure out if a company is a low-cost producer? I mean, that's a big advantage, right?
It is. Gives you an edge, Dr. Malik says, to compare operating margins and EBITDA margins.
Wait, remind me, EBITDA, what's that stand for again?
Earnings before interest, taxes, depreciation, and amortization.
Right, right.
Basically, it shows you how profitable a company is from its core operations.
Strips away some of the accounting noise.
Exactly. And the company with the highest margins in its industry, they're likely the low-cost producer.
Because they've got their costs under control.
Exactly.
All about efficiency. Okay, last question from the mailbag. How do you identify a company's peers, especially if they're in a niche market?
That can be tough. You need apples-to-apples comparisons.
Right, comparing Apple to a corner store wouldn't tell you much.
Dr. Malik suggests getting help from the internet. Look for suppliers of similar products on wholesale portals, like IndiaMart.
So it's like crowdsourcing your competitor research.
You could say that. You can also try contacting dealers and distributors in that industry, or even the company itself. Ask about their competitors.
Be resourceful. Use every tool you've got.
Right.
Wow, we've covered a lot.
We have Dr. Malik's insights, his tools, practical tips, real-world dilemmas.
I feel like I just got a crash course in business analysis. So, if our listeners only remember one thing from this deep dive, what should it be?
I'd say it's those two fundamental factors we talked about earlier. The uniqueness of a company's product or service and the level of competition.
Like those are the pillars, right? Everything else builds on those?
Absolutely. They shape a company's pricing power, their profits, their long-term success.
So first you understand the core dynamics of the business.
Right. Then you can apply the tools. Analyze sales, profits, cash flow, management quality, even valuation.
It's like a mental checklist you can run through.
And even if you don't have time for a deep dive into every company's financials,
Which, let's be real, most people don't.
Dr. Malik's short method is a lifesaver, quick and effective.
To see if a company has that moat, that competitive advantage.
It's a great tool for anyone, really, seasoned investors or beginners.
Okay, so to wrap things up, we've got a challenge for our listeners.
Ooh, I like a good challenge.
Think about a company you interact with regularly. Any company. A brand you love, a service you use. Maybe even a company you're thinking of investing in.
Got it.
Now put on your analyst hat. Ask yourself, do they have a unique product or service? How much competition do they face? Can they raise prices without losing customers?
It's like a mental workout.
Flex those analytical muscles.
You might even spot some hidden investment opportunities.
You never know. Well, there you have it. Our business analysis deep dive, inspired by Dr. Vijay Malik.
Remember, knowledge is power.
Especially in business. Keep learning, keep exploring, and keep those critical thinking skills sharp.
We'll see you next time for another deep dive.